welcome back to this week's market update. This is Frank filling in for Kelly on Friday, May 5th. This week was full of activity, so let's jump in here. The first trading week of May saw another major regional bank failure. On Monday, banking regulators seized control of First Republic Bank, which had been teetering in the last few weeks, and there have been a lot of headlines regarding it. And regulators accepted bids from JP Morgan Chase for pretty much virtually all of the lender's assets. On Wednesday, during the third FOMC meeting, Federal Open Market Committee meeting, the Fed approved its 10th interest rate hike, raising it an additional 0.25%, bringing the Fed's funds rates to 5.25%. This is the highest interest rate level in over 15 years, so it's quite significant. The post-meeting statement hinted through omission that there might be a potential end to rate hikes. And this was something that investors were keen to latch onto. As of Friday's close, equities traded generally flat, while yields took a beating for the week. The S&P 500 lost about 0.76%. The Dow Jones dropped just over 1%, and the Nasdaq Composite had a slight gain of 0.19%. While the U.S. Treasury yield fell dramatically, closing out the week down negative 6.13%. Bank failures have been putting pressure on the markets. As we mentioned earlier, First Republic's failure on Monday is adding to confirming evidence to many consumers of a widening banking crisis. On Thursday, PacWest Bancorp shares fell over 50%, which is, at this point, an incredible 90% decline since the start of the crisis about 2 months ago. Several potential investors have approached the bank to discuss possible options, including a sale of the bank and its assets. The three U.S. banks, it's important to note that the three U.S. banks that collapsed this year had more combined assets under management than all 25 federally insured lenders that failed in 2008, the onset of the Great Recession. This has caused great alarm and debate among a lot of investors as to how dramatic this is going to end up being, and some are saying that these bank failures are simply, an indication of the Fed's efforts to tame inflation, that they're working, while many believe it may be a prelude to something much larger. International trade, on the international trade field, the U.S. Census Bureau and the U.S. Bureau of Economic Analysis announced yesterday that the goods and services deficit was $64.2 billion in March, down from $6.4 billion from $70.6 billion in February. March exports were $256 billion, which is just about a little over $5.3 billion more than February exports. March imports were $320 billion, down $1.1 billion from February's imports. And it's important to remember from a portfolio perspective that, the balance of trade and how that affects the portfolios influences currency exchange rates through its effect on foreign exchange supply and demand. And this, of course, influences currency prices and ultimately the strength of the U.S. dollar in the world. U.S. debt is in the spotlight again. Treasury Secretary Janet Yellen informed Congress on Monday that the government is on the verge of a catastrophic debt default by as early as June 1, unless lawmakers decide to raise the debt ceiling. Of course, we don't think that's going to happen. We think the likeliness of that actually happening is pretty low. That's never happened before. But of course, during the political negotiations, both parties refused to budge over the $31.4 trillion, I think is what it is today, debt ceiling. This standoff has had a dampening effect on the market and caused investors to rush to risk-off positions, causing a broad sell-off. So over the next few weeks, we expect traders to be focused on the political solution to this problem, because a government in a debt default could spell massive trouble for an already volatile economy. Oil prices have slumped to a 5-week low this week and then closed flat on Friday. Oil prices ended mixed on Thursday after the European Central Bank, which followed the U.S. Central Bank's kind of lead, approved a rate hike of 25 basis points or 0.25% to their interest rates. Energy continued to be one of the biggest drags on the market. Brent closed down on Friday about flat for the month. It's closed at $75.30 a barrel, while WTI crude fell 34 cents to close at $71.32. This week, employment saw stronger than expected non-farm payroll employment total of 253,000, while the unemployment rate was smaller than expected at 3.4%. But professional services, healthcare, and hospitality and jobs in those fields all continued to trend in the upward direction. With job gains back over 250,000 last month and unemployment sinking back down to where it was in the 1960s, it looks once again like job market is proving to be more resilient than expected in the face of the Fed's efforts to tame inflation. It's going to be interesting to see how the latest Fed interest rate hike will affect the labor market by the end of May. Well, that wraps up this week's update. As always, we're constantly monitoring the markets, inflation, the Fed, interest rates, corporate earnings, geopolitical events, and all things investing. Thank you again, and we look forward to providing another update soon.